Welcome everybody. This is the Bishop Fleming 2024 FE client webinar. Thank you for joining us today. My name's Nathan Coughlin. I'm one of the Bishop Fleming external audit partners who works across the FE sector. There's been a lot of change in the sector over the last 18 months post ONS reclassification, and also a lot of new sector guidance issued very recently. So we thought it was ideal timing to run a session for you today. We've got 4 speakers for you today on some of the topical issues we're seeing in the sector. We've got, I'll start off covering off the new college financial handbook and some other recent accounting updates. And I'm going to pass to my colleague Alistair Campbell, who's head of internal audit, who will cover off risk governance and internal control matters, including some of those that are highlighted in the handbook. And then we've got Verity Rowe and Len Dean coming in, covering off topical direct tax and VAT issues for the sector. So this webinar is being recorded today so that we can share it with others who couldn't make it for this time slot, and just some housekeeping points to cover off how this is going to work. If you'd like to ask a question through any of the presentations, we'll try our best to answer them and cover them off at the end of the webinar. So if you want to ask a question using Teams, you click on the Q&A button on the screen. And if you logged into Teams already, the system should recognise you. If you've logged in as a guest, you can have the option of typing your name and company, or vice versa. If you're logged in with your name, there's an option to ask a question anonymously as well. All questions will be hidden from view until we moderate them, and then we'll publish them through as we go through the webinar, and we'll respond to as many as we can at the end of the session. If we don't get to all of them, we'll send out something afterwards that collates the questions and our responses. Okay, that's a summary of the contents then. Let's make a start. So, implications of reclassification. When setting up this webinar, I was expecting a good proportion of this to focus on the impact of the publication of the much anticipated first college financial handbook. It was highlighted promptly following the ONS reclassification of colleges as public sector, that would be following the rules of the Treasury document managing public money from that point forward. And of course, it's a handy little document over 230 pages. Soon after the reclassification, it was highlighted that the ESFA would be developing a financial sector handbook, which would support how the rules of NPM should then be applied to us in the FE sector. Last year, a number of bite-sized guides were produced that covered some of the key changes or restrictions following the reclassification, in anticipation of this more complete college financial handbook being produced. Well, the handbook's here now. It was published last month. And it's got an effective date from 1st of August, so for next financial year, which was all as planned. At a high level, the good news is it doesn't really appear to bring any additional restrictions or expect colleges to do any additional work than I would consider standard practice for well-managed and well-governed colleges. It appears to broadly pull together the bite-sized guides along with other existing guidance and regulations for the sector, and covers roles and responsibilities for governors, accounting officers, etc. So it pulls in references to other documents such as the College Financial Planning Handbook requirements for budget setting, guidance for charities, where relevant, as of course we are exempt charities in the FE sector, procurement legislation, subcontractor rules, the AOC's Senior Postholder Remuneration Code, and the Audit Code of Practice. So the document focuses very much on what colleges need to do to ensure they comply with those expectations, not so much on about how it should be done in all cases, and therefore it's included links to other documents of best practice. So it's got things like links to best practice for budget setting, for good governance, etc., where it can think about more the how you're going to implement those things. But the big picture to start off with for me is that it's actually, I think it's quite a helpful framework that pulls together all the requirements from different documents and codes, and then signpost it where further we can look for support. One thing, if you've looked at this already, you'll notice is different, is the introduction and references to these musts and shoulds. If you're a college that's also associated with academies, you probably recognise some of these terminology and the use of the bold musts throughout the document. They're defined in the document, but they're fairly self-explanatory. Must mean statutory, contractual or other regulatory requirements such as but not limited to charitable rules and public sector spending rules. And examples of those things like the new restrictions such as you must get approval for new borrowing, and others are more standard practice like you must approve a budget. And should is slightly more important as a definition. Should means good practice that colleges should apply unless they can demonstrate an alternative approach that suits their circumstances better. So I comply with this process or explain why it doesn't apply to you. And some of those examples are things like the board should set and review reserves policies, the college should consider the financial benchmarks set out in the FE Commissioner's guidance when setting budgets. Interestingly, the document then states that auditors' regularity opinion must consider compliance with the handbook. How auditors will do this, I think, practically is an area that needs a bit of further consideration. At the moment, most of these musts are actually kind of captured in the regularity self-assessment questionnaire that's already in place that you complete for the auditors, and it may be that's developed on further for next year end when this is applicable. In the academy sector, we have these kind of things already, and we have must checklists that we use with clients to make sure they can evidence compliance. And if there are gaps within the sort of self-assessment questionnaire, that's probably something we'll look at again for the college sector as well. So I think the key thing here is it's crucial that you're not only able to comply with the guidance, but actually you're able to demonstrate and keep records of how you complied with the requirements. In total, being a bit of a control F, there's 162 references to must in the handbook, so quite a lot to look at. Much fewer shoulds, and some of those it's about 67, but some of those are actually sort of shoulds in terms of common language, so it's not necessarily additional things you need to do there. So as I said before, I don't think this will require many colleges to act differently, but I think it will create some work to demonstrate compliance. There's just a few areas where I think things are a bit more specific than they have been in other documents in the past. One is it's a bit more specific about when you need to revisit your scheme of delegation to be approved. So the scheme of delegation has to be approved by the board and reviewed whenever there has been a change in structure, or at least every 3 years. Again, I think that's is normal practice anyway. Colleges must select financial KPIs to monitor performance. Again, I think we've seen over recent years the direction of travel for board reporting going this way anyway, and close monitoring of things like the ESFA financial health indicators as well. So I think this is a continuation of that journey. And then the last one, I know we certainly had discussions with our clients around this over a number of years around related parties. When you're doing things like consideration of related parties and declaration of interest, you must consider close family members, not just governor's own interests. They need to think about the spouse and their children as well. And I know we discussed that as part of our auditing approach as well. There's a number of areas on risk and governance as well, but Alistair will cover those a bit later. So what I thought I'd do with the rest of this time is highlight some of the changes and the implications of some of the changes that we've seen since reclassification. So the most consistent challenge we've been seeing is around funding. The new arrangements require that all new borrowing is approved by the ESFA, and the handbook states that such borrowing will only be approved in exceptional circumstances. And that's because it feels it's almost impossible to find a scenario where you can provide value for money for the government as a whole over lending directly to colleges themselves. So the main issues we've seen is actually being caused due to, I think, how the restrictions were implemented, i.e. immediately from the date of reclassification with little notice for colleges. So there were a number of organisations going through sort of refinancing process at the time, or just having advanced discussions to put new facilities in place, maybe for new ventures or investments. We'd also seen colleges caught out through wanting to make drawdowns on existing revolving credit facilities as well, which are also captured by the guidance as new funding. And in addition to that, sort of almost complete that perfect storm for us, the timing of such was that we were in a really high inflation environment with a number of inflationary cost pressures being put on colleges, and we were seeing some colleges struggling to make sure they complied with their loan covenants in that year in terms of their debt service ratios. Banks, of course, wanted to consider repricing in response to having to issue waiver letters for any loan covenant breaches. However, amendments to terms such as interest rates are captured by the requirements to be considered as amendments to borrowing and therefore need to be approved by the ESFA. So you get stuck in this cycle. So what was the outcome of this? Essentially, we've seen an increased number of requests or discussions with the ESFA to help resolve some of these discussions around loan arrangements and consideration of taking out loans with them. I think if colleges were aware this was coming, I think there'd be a greater ability for them to plan for this, but we are where we are with this now. And there have been capacity constraints, I think, at the ESFA in terms of actually the volume of queries and discussions around lending, and actually the ability to make some the volume of lending that's been required. And that's taken a little while to work through. And as a result of that, we've seen some delays in financial statements being signed off over the last year, or acceptances of things like material uncertainties in relation to going concern. Paragraphs added into audit opinions whilst funding arrangements are still being finalised. Obviously, I think a big portion is to be a one-off issue. Volume should normalise going forward, and then reduce over time as we move to a position where we have limited external funding in the sector. But I think in the meantime, the key message from us would be absolutely closely monitor your compliance with loan covenants. Gives you the best position to be in terms of actually having those discussions and negotiations. And if there are issues, highlight them early to the ESFA. The next most common area we've been talking about with clients around severance payments. Challenges here have been knowing exactly when to get approval and evidencing compliance with the guidance. Essentially, I'd say if you're looking at paying anything over and above a statutory redundancy package, make sure it provides good value for money, and it's not just being taken as an easy option of dealing with poor performance and resolving an issue that way. Legal advice should be considered, particularly if you're considering things like confidentiality clauses. And for regularity sign-offs, it's crucial you've got that clear documentation of considerations and decisions and approvals. For significant payments or payments to highly paid individuals, you may often need to get ESFA approval in advance. So there's thresholds in the guidance, and it's about broadly if it's over £50,000 payments that are non-statutory or over 3 months' salary, or if it relates to people who earn over £150,000. The confidentiality clause points actually also cause some difficulties around some of the disclosure in the accounts. So the requirements of having to make disclosure about the values and the numbers of them sometimes cause conflicts with actually the terms of confidentiality clauses. So if you've got something like that, again, have early discussions with the auditors about how you can sort of get through that position. For those who are trading subsidiaries, you probably recognise the challenge around letters of support over the last year and getting the sign off of those. In particular, if you've got a subsidiary that's got trading balance or loan balance with a college that's not structured debt, i.e. repayable on demand, then letter of support is a good way to provide support over going concern for the subsidiary company directors and the auditors. You now need to get ESFA approval in advance for such letters. Last year, they set out that they were going to approve them, but only if they met certain criteria, including the restriction that the value of the comfort offered does not exceed the value of the current liability balance with the college, i.e. no more funding or cash flow support will be provided to the subsidiary. So the key here is that you need to ensure that trading subsidiaries are not only profitable in the longer term as a venture, which you will already be doing and focused on, but also cash generative for at least the next year ahead in the shorter term. So you're not going to be required to put additional support into it. Some of the other areas where we've seen initial discussion and confusion are around the introduction of the terminology of novel, contentious and repercussive. These are defined in the guidance. I think that some of these are now actually becoming clearer what people understand by these. Novel is something essentially you've not an adventure or type of a transactional activity you've not been doing before. Contentious is more about thinking about what third party or the public or the media would think about. So, for example, common things are disposals to related parties below market value. Think about the wider public sector, councils drawing down funding to invest in things like shopping centres or office blocks, areas of expertise they haven't got. And repercussive is about if you're doing something that you think could have a wider implication for the sector. So if you're thinking about something innovative that actually, or if it comes off, the whole sector would be interested in it, could have some wider implications, have to think about whether that should be flagged to the ESFA. But if in doubt, I think the answer there is have a discussion with the auditors as well. But if in doubt, put it in with the ESFA as a request in advance. Just a couple of quick reminders on the other two there. Approval for write-offs. We're not seeing too many problems with this at this stage yet. I think the one thing to watch out for is the cumulative requirement in there, and where colleges make best endeavours to chase and collect debts regularly, but sometimes it's a periodic process to write off the debts, and because it's a cumulative write-off threshold, I think you need to think about the timing of those just to make sure those sweeps making sure you're not actually getting it near any of the thresholds for the SFA approval. Disposal of fixed assets, again, just a reminder that it's about the use of disposal proceeds. The bite-sized guidance was revised and clarified to make sure it's clear that you can use it to repay borrowing, not just to reinvest in other fixed assets. There is also a further option, being able to use it for working capital, but that's only in exceptional circumstances with the SFA approval. Okay, so the other things I just wanted to highlight were updates to the sector guidance. The accounts direction for this year is out. Some positive news, I guess, there is that there's not significant in terms of numbers of changes. There is some narrative around recognition of pension assets in there in one of the sections. It still sort of it puts it back to the college and the auditors to agree what the most appropriate approach is. But reading between the lines, I think it's looking to take a fairly prudent approach in recognition of pension assets. So it states, note the constrained circumstances that allow for recognition of any such surplus as an asset, whether it's able to recover the surplus through either reduced contributions in the future or through refunds from the plan. So it's kind of suggesting that only if you're going to get cash back from this, you should be recognising the asset. But the crucial thing, I think, which is right to flag, is you make sure that you're clear in terms of what judgments you've made and what conclusions you've reached when disclosing that in the financial statements. The other amendments are fairly minor in terms of making sure we're disclosing things separately, like the holiday pay accrual. So nothing significant changing there. The other key sector documents out is the audit code of practice. Small number of changes again highlighted. There's a reference to the funding audit document that the ESFA produces, which highlights some of the common issues coming from funding audits, which is also always useful to be aware of. Then the other point around Annex Gs, which I think is really positive news, is I think we've certainly found that we've been signing off a number of Annex G audits for pretty small values over the last year. So the feedback has got through to the ESFA on this, and actually it's going to be much more risk-based. So I presume that will mean the higher value grant claims, and more assurance will be placed on regularity opinions. So I guess that puts more of the focus and work around the auditors at year end, considering what are the material grants that have been funded in the year and how are we comfortable that they've been used materially for the right purpose. But I think that's a much more proportionate approach than actually getting an Annex G done for every individual grant claim. And then very finally for me, in the pipeline, there's amendments to FRS 102. So this is the periodic review of the accounting standards. That's now been published after going through an exposure draft, and the timing as such is that it relates to periods beginning on or after January 2026, i.e. that's for us 31st July 27 year end. So it feels a little way off yet. But key changes to be aware of is broadly bringing in IFRS 15 and revenue recognition for into play, and also IFRS 16 on leases, where I think there'll be more work to do for us as a sector, and that would be broadly suggesting that any leases that run over 1 year will be brought onto the balance sheet, subject to a sort of de minimis level. So small, low value leases not necessarily need to be, but things like car leases or something, for example, it might have been classed as operating leases before, will now be brought onto the balance sheet. So a bit of work to do ahead of that one in terms of for the conversion. So that's probably one to start thinking about ahead of time. But I'll pick that up more on our next update on this, because we've got a bit more time on these ones, and we'll speak to you soon about that. Okay. And that's me at this stage. So I will now pass to Alistair, who will pick up risk governance and internal control matters.
Thanks, Nathan. Very interesting points to note, and I'll pick up a couple of those themes as we talk a bit about risk governance and internal control. So let's get back to the slides. So the points being, just to reiterate a bit of what Nathan said, the new handbook does pick up some points that have been effectively in the sector for a while, drawing together guidance from existing publications and also general best practice into one helpful bite-sized 230-page document. So picking up the ACOT, the Accounts Direction, the Governance Guide, etc. But yeah, nothing significantly new or changed. But the point I wanted to bring out was there a bit of an emphasis on demonstrable compliance with, as Nathan said, with all the must statements themselves, but also there's quite a bit of a focus on roles of governors, roles of management, but particularly for governors, board members, demonstrating that you are lifting the guidance off the page, that you're acting it rather than just paying lip service to it. So compliance itself does need to be evidenced, your must statements. So internal audit can help you with that. We can provide a direct evidence, do a review of compliance or a review of your own self-assessment of compliance, but we can also help with a lot more areas. So risk management, internal control. I've got quite a few sort of busy slides, but they're mainly for reference for when you look back at the set afterwards or look at the recording. So I won't necessarily go through each point, but just to pick out some highlights. Responsibility for risk management is again reiterated as being very clearly the role of the board. It can't be delegated to management or the audit committee, although both clearly play a key part. You may also draw in other committees, but it's the board itself that needs to demonstrate they are owning and leading on risk management and understand all the risks and have assurance that those risks are being well looked after. The board should review the risk register frequently and must conduct a full review at least annually. But I would suggest to you that if you, as a board, are only looking at your risk register once a year, then perhaps you would have difficulty discharging the other parts of this guidance that says that you need to be that sort of continual overview. You should also, there's now explicit guidance that says, or just reiterating that you need to be clear that you're considering risks for delivery of all funded provision, particularly through subcontracting arrangements, and so you need to know whether they're adequate and whether regular contract monitoring is in place to mitigate those risks. So those should be on your risk register, but equally you should receive some regular information and reporting from management that provides assurance that those risks are under control. And another quick point, just to note that risks must include contingency and business continuity planning, noting that the FE Sixth Form College's Governance Guide notes that maintaining an up-to-date business continuity plan is actually a condition of funding. It's a funding requirement. So you need to make sure you have one and it's effective. It's not just a paper document from 4 years ago. So just a quick reminder on audit committees. There's quite a lot of guidance floating around the sector generally about audit committees, but just picking out some of the key points. Again, it's that emphasis that risks need to be appropriately monitored and controlled, but it's not the audit committee's role to manage the risks. It's the audit committee's role to make sure that someone is managing the risks and that they're managing it effectively. So the audit committee are custodians of the process rather than the actual management of the risks themselves. They do consider outputs from other activities, third parties, including funding auditors, investigations, external reviews of governance, internal and external audit. And you need oversight of subsidiary companies, subcontractors. In essence, everything and all activity that the college is involved in needs to fall under the remit, as well as making sure that you do monitor that actions arising from those reviews have been implemented properly. The colleges must also be aware of the risk of cybercrime. This is a must, and I think it's reflecting the fact that the government has certainly in recent years taken cybercrime a lot more seriously. You must have proportionate controls in place and take action where you identify an incident has taken place. And it is now also a must. You must not pay any ransom demands. So this is you don't have any choice. You don't have any consideration. The government's position is that colleges and other publicly funded bodies must not pay cyber ransom demands. Just a few other issues on risk and control that we're seeing across the sector for information. Government recruitment and retention, skills, getting that mix of required skills, certainly with these increased and expanding requirements, is proving difficult. To get those people to, it's a significant time commitment, and certainly if where they all have other busy day jobs, it's quite difficult sometimes to have a continual commitment to the time required. Equally, staff recruitment and retention, a bit of an issue, certainly at the lower end of the pay scale, perhaps. where cost of living has meant that other jobs, supermarket jobs, other private sector jobs have been upping the sort of hourly rate a bit, and that's tempting people away from previously perhaps those who might have had a bit of a vocational pull. Issues we've seen recently across wider education sector is right to work requirements. Certainly the more recent changes with share codes for non-UK nationals actually being evidenced and checked at the point of appointment. That's not always been as clear, and teams not understood the full requirements, so it's worth a quick check there. But overall, actually, there's still a focus too much on the left-hand side of the risk register, which is what are our risks, and not enough on the right-hand side, which is what are we doing about it? Are we doing enough? How do we know that those controls are working? What other actions should we take? So those answers to my two key questions on risk management. Do I know the risks faced by my college, so the left-hand side of the register? And how am I assured, or where's the evidence that those risks are adequately controlled in practice, the right-hand side? And a lot of this guidance, both on risk and governance and control, focuses very much on that right-hand side. You as governors and as management teams need to be clear that you're doing enough. So a quick trip through some of the codes, as I say, not necessarily to pick up all the points, but essentially the FE and Sixth Form College Governance Guide has set out that all colleges must comply with one of the existing codes, at least one. You can pick as many as you like, but you have to be clear that you've picked one that's relevant and be able to explain why you feel it is relevant to you. You also must either fully comply with it or decide that you don't, but report why you don't and those reasons for non-compliance. And interestingly, the DfE do state formally that they expect colleges to aim to exceed the standards, not just simply comply. So they're very much seen as a minimum. So you must, as a minimum, comply with the principles, but really we expect you to be doing more. And to pick that up, there's this review period. So every 3 years, you're asked to have an external review of your compliance with code, external review of governance, and you carry out an annual self-assessment in the other years and an evidence-based self-assessment. How have you got evidence that you can review and demonstrate that you've addressed the principles in practice? How have you actually reviewed to provide that assurance to both board and others that you've understood the principles and applying them? Have you identified the gaps of non-compliance or where you still need to be strengthened or improved? And what actions are you taking to address those gaps? All of those points are explicitly stated as elements of a self-assessment. So when we come as internal audit to look at your self-assessment in those mid-years between your external reviews of governance, that's the sort of thing that we'll be looking at. And just as a final quick point, publishing the results of your external review of governance, you are and your associate action plan, you should be on your college's website, but the guidance on this was updated recently, with noting politely that perhaps you should just agree your own summary of the outcomes of a review with the formal reviewer, because I think it's been noted that a couple of colleges had perhaps interpreted their own results in their own way, and it wasn't necessarily in line with the spirit of the findings. So that's a bit of recent change. Some other points to note, just to pick some of these. So recruitment and skills are still, and succession planning are both crucial. Picking up those points, you need the right people in the right place, but are also still proving a challenge, as we said. There is more emphasis now in all those codes around the chair, the post of the chair, but also the role of the governance professional, which is now much more than just a traditional clerk or minute taker. So those two roles are pivotal in making sure that you lift this governance code off of the paper, and very much therefore picking up those risk points, that there is an evidence-based assurance process that says we know that we are receiving the right information from management. For example, governors have been explicitly tasked to test senior staff, have developed business cases, have sufficient and robust data to support performance, and have fully considered the risks involved. So that is governors being asked to test staff and show me the evidence to make sure that things are happening. So in summary, it is just drawing together at the moment. So both the handbook and those codes draw together existing requirements, but there is naturally, as a result, an opportunity to review what you're doing on governance and risk. But there is this greater emphasis, both through the new college handbook and the associated governance codes, of the role of the board and the audit committee to make sure that you have evidence-based assurance from both management and third parties informing your overall view on how well your college is mitigating risk and actually performing. So use your internal auditors to help would be my final comment. We can help you with compliance for the musts, but also on those self-assessments. We can help you discharge your responsibility to make sure that recommendations are being adequately implemented. We can help you confirm those assurances, that right-hand side of the risk register, as well as just the controls, and help you with wider governance and risk management development generally. So just talk to your auditors, make sure you make the best use of them. And at that point, I will hand over to Verity to pick up some tax points.
Okay, thank you, Alistair. So I'm just going to pick up a bit of a refresh on corporation tax for colleges. So as I'm sure many of you are aware, most colleges do not pay corporation tax, and this isn't because they receive a blanket exemption, but because they benefit from a number of charitable exemptions on particular income streams. So corporation tax can become a potential issue for colleges when they start to diversify their income streams to generate additional funds by carrying out what we call non-primary purpose trading. So that is trading that does not fall within their charitable objects. The main examples we see in colleges are sort of sports lettings to the local community, childcare facilities that are made available to the general public, refreshments and catering facilities such as cafes, unless it's run by the students of the college, and solar panels is another area where there could be potential taxable income for a college depending on the nature of the agreement. So there is a small trading exemption. So this allows a college to generate up to £80,000 a year from non-primary purpose trading without creating a taxable trading activity. So once this limit is exceeded, the total income becomes taxable in full. So in this position, the college would be required to submit a corporation tax return for the year to HMRC, even if after the offset of associated costs and an allocation of overheads, there's no corporation tax liability payable. So potential corporation tax liabilities on any non-primary purpose trading can potentially be mitigated by the use of a trading subsidiary. So a trading subsidiary can be set up to carry out the non-primary purpose trade on behalf of the college. The subsidiary can then donate any taxable profit arising on that activity to the college. So this would result in no corporation tax being payable by that subsidiary and exempt income being received by the college. Under general corporation tax rules, a company only receives a tax deduction for a donation in the year that it's physically paid. However, providing the subsidiary is wholly owned by the college, legislation does allow for a wholly charity-owned company to claim relief for a donation that's paid within 9 months of its year end. So this just gives the subsidiary time to prepare a corporation tax computation, to work out the actual taxable profit for the year and the level of donation required. So it is important to note that a donation to the college must be a physical payment between bank accounts and not just an intercompany transaction. So the subsidiary does need to have sufficient cash to be able to pay the donation to the college. Qualifying charitable donations are also considered to be distributions, and so the company would also need to ensure it has sufficient distributable reserves at the time the donation is paid to be able to pay that donation. Mismatches between tax and accounting profits can create issues with a trading subsidiary's ability to be able to donate its taxable profits if it's not managed effectively. So if you have a taxable profit that's higher than the accounting surplus, this could potentially lead to negative reserves in the future. Typically, we'll see adjustments needed if the subsidiary holds assets or has its own employees, and this is because of the tax adjustments that are potentially required in relation to depreciation and pension contributions. So where a college has a subsidiary, there are some other factors that would need to be considered. So management charges, the college would need to ensure that any services provided to the subsidiary or use of assets owned by the college are recharged to the company at cost. So any management charge would need to be reviewed and updated annually to accurately reflect the time and use in that period. An incorrect charge can have tax consequences for the college itself, either in the form of non-primary purpose trading or non-charitable expenditure, leading to a loss of some of the charitable exemptions that are available. So funding is another consideration. The college would need to ensure that any investment into the subsidiary would meet the conditions of an approved charitable investment. So generally, this will mean the investment needs to either provide a charitable benefit, so help to advance the charitable objects, or a financial benefit to the college. Loss-making subsidiaries can also be another issue. So where a college is supporting a subsidiary that is making a loss and has negative reserves, there is a risk HMRC could challenge that the college is incurring non-charitable expenditure or holding an investment that's not in the college's interest. So in this scenario, the college would need to evidence that the position has been considered and the college remains happy about the return on investment that the subsidiary is expected to provide. Just as a final area to pick up on corporation tax, just on property disposals. So generally speaking, a chargeable gain arising on the disposal of a property would be exempt in the hands of the college, provided the proceeds are then applied for charitable purpose. The area where we do see some potential corporation tax implications is where if a college sells some land or property to a developer and the sale agreement includes an overage clause that results in the college receiving additional funds from the sale in future. So this overage payment would potentially be taxable income for the college. So in this scenario, there may be scope to look at whether the overage could be sort of routed through a trading subsidiary similar to the non-primary purpose trade to try and mitigate any corporation tax that could arise. That's all I was going to talk about for corporation tax today. So I will now hand over to Len, who will talk about VAT.
Thank you, Verity. Yes, just a quick update on the VAT position of FE colleges. There's been a number of cases that have questioned HMRC's long established view of the VAT status of FE colleges. And by now I was hoping to be able to update on further litigation that HMRC are taking. But actually the latest case that came out earlier this year, a first tier tribunal, was again Colchester Institute, and it was a follow-on case about some assessments HMRC had applied for their particular circumstances. Just a quick recap on Colchester Institute is a case that went through to the upper tribunal in 2020. It concerned a number of things, but it was in the context of buildings the college had built a long while before that didn't qualify for VAT relief under the zero rate for relative charitable new buildings. And that college had sought to recover that VAT under an old mechanism called Lenarts, which is no longer applicable, where colleges could get back VAT up front and then essentially pay it back as they use the business for non-business purposes. Anyway, Colchester, with their advisors, took a case saying, well, actually, we don't think we are using this building for non-business. We think our funded further education is VAT exempt and is a business income type, but it's exempt. They were ultimately successful at the upper tribunal. But the interesting thing is that HMRC won for other reasons on that case, essentially meaning they could get back the lump sum of VAT that Colchester had originally claimed. So they didn't appeal any further. So that case didn't proceed further. HMRC left it and essentially sought to ignore it. The issue arising for the sector as a whole from Colchester is that if funded FE education is business VAT exempt, then the zero rating for new relevant charitable buildings, which I've mentioned, which is a very valuable VAT relief for a lot of colleges building new buildings, if the education is exempt, then that VAT relief would fall away because it has to be purely for buildings used for non-business purposes, which is a very specific VAT concept. So what HMRC did is said, look, we don't agree with that outcome. We're not appealing it any further, and issued a brief in 2021, brief 8, which says HMRC's policy remains that colleges are eligible for the relevant charitable purpose new building zero rating relief, but they can choose which VAT treatment they want to apply to themselves, because I think there is a number of other colleges pursuing the Colchester Institute route for various reasons. And HMRC is saying in that brief that they'll protect their position against those that try and apply this other VAT analysis if it results in them getting additional VAT back for other reasons. So even now, that brief is still in place. The VAT notice on education 70130 and HMRC's internal guidance manuals all still reflect the position that the 0 rating for new buildings is still available, subject to meeting the conditions. And the brief also says that HMRC are looking at taking another lead case to test this issue and in their view, hopefully confirm that they were correct all along. The interesting thing is, though, that when this further case on this related to this principle came out, it was referring still back to the upper tribunal decision in 2020, which suggests it's still the lead case on this area, and that HMRC's alternative case hasn't proceeded to through the courts yet. So where does this leave us? Yes, there's a question mark about the VAT status of FE colleges because of the Colchester Institute upper tribunal decision. HMRC have been very clear in published guidance that they disagree and that colleges can still rely on the old rules, if we call them that. But I think change could be coming if further cases test this principle and uphold what the Colchester upper tribunal decision. Then I think that significantly further changes the VAT climate for FE colleges. They miss out on the charitable VAT relief for new buildings, which is very valuable when new buildings are being built. But then there's a lot of other stuff that relates to their more minor stuff that relates to their non-business status that could fall away. And then I think you'd see a scenario where FE colleges were further disadvantaged in terms of VAT. As you know, you'll be aware, academies have a very specific VAT regime that's applicable to them, which essentially means they get pretty much all their VAT back. And FE colleges would then be sort of stranded with almost no VAT recovery and no charitable VAT reliefs that they can use. So I think as this progresses, it's one to keep an eye on, and there could be further changes, or even at government level. I know the Labour government have made announcements about other areas of education that they're looking to change, whether there would be a process in due course to consider the wider education funding and VAT position in the UK now, and see if they can make it a bit fairer for FE as compared to the academy sector. So it's one to watch, but if you're considering a new building now, well, then you've still got published HMRC policy and the brief to say that you can still seek to apply the VAT relief for the 0 rating for new buildings. How long that lasts for is unknown. And last thing I'll say is from discussions with colleagues in the sector, specialists in this area, the expectation is that if the rules do finally change, it will be future looking only, and that it's not expected that HMRC would seek to apply them retrospectively on colleges that have relied on HMRC's guidance thus far. So yeah, that's the VAT position as it currently stands. Watch this space, and on that note, I will hand you back to Nathan for the wrap up and Q&A bit.
Okay, thank you very much, everyone. I'm very conscious of time. We've only got sort of 1 minute left of our presentation slot with you today, so we've timed that perfectly. So, and that's just ticked over. So I think what I'll do with those questions we've got there is they all look like they relate to Alistair's section there, so I'll get him to draft a sort of a summary response to each of those, and we'll circulate that to everyone attended today following this. So I don't want to take up any more of anyone's day, but I hope you found all of this really useful. Please do pick up any sort of further follow-on discussions with us, and if you're watching this in arrears, do make sure you pick it up with your regular Bishop Fleming contact, and we'll hope to speak to you all soon. Cheers, bye.